Good morning, Ken at Tortoise Capital with a review of the weekend trading report for February 22nd, 2020. Market is in bullish normal conditions, overbought on an annual and a 90-day look-back period, middle neutral on 30-day and 10-day look-back, and deeply oversold on a breakdown on Friday for the 3-day look-back. Price with respect to the 200 is green bullish. The ADX is weakening at a neutral 20.1. Bull still in charge. The risk Z has started to roll over, as you notice here, with the Z score of minus 0.30. So this is a warning of rough seas ahead. We had a nice little run on the swing trade when this was rising in the spring, but we are back into the winter on volatility for the risk Z, so that is a warning shot. See the holdings for blended monthly rebalancing for the different portfolios for the month of February, and then going into the week ahead. ETF2 has reduced its exposure to 50%. There's a good first of the weekly podcasts located at patreon.com/KenLong, 35-minute lessons for your review. Monthly market health check. Looking at the monthly charts, you can see we're pushing still out here at Z2, so very favorable still. You can see the dragon, the PSAR, the rising 90, rising dragon, rising river, and fair value all the way back here at about 240. The Z3 excursion is about 348, and then the breakout above the monthly high would be an all-time high. We are still well in the summer on the monthly health check. Looking at the weekly, a little more refined tune. It's rolled over at Z2. Closed weekly poorly, I should say. Skin of the dragon, belly of the dragon, PSAR, RL90, and then fair value aligned with the Bollinger Band mean. That's the real support level at 310. So there's a $20 move between here and there, so that's about an 8%, 7%. The 1-day, 10-day, and 30-day lookbacks on the daily here. We just rolled into the fall in MACD, so that is a warning shot and closed weekly. It found support at the PSAR and held, but still pretty weak. Bollinger Band mean, Z-1, fair value at about 326. Z2, here's the belly of the 10, the belly of the dragon, so plenty of targets on the downside to calibrate our estimate of what's possibly ahead. Breakouts to the upside have to get above, looks like about 338 and some change to make a new 10-day and 30-day high and break out above the RL10 hump. The Z3 excursion, the Z2 excursion, and then halfway. So fall, summer, back into the fall, it's the downside risk is the more likely one right now than the upside gains. Some quick looks at the BMR portfolios of different compositions, about equally split between buys and cash. Big winners this week really was a defensive place like treasuries, and even the strong ones were given back. Utilities, another defensive play that held up okay. Real estate held up pretty well also, so it was a week for defense. ETF 32 portfolio, the same thing. Even tech got smashed on some weakness in Apple. The Dow 30, all of the leaders got smashed. Tech. Chevron, ExxonMobil, 3M, all in the weak areas here. Getting weaker. So this is not boding well for the week ahead. First warning shot. Same thing in the sector spiders. Retail, transportation, and treasuries did well, but all of your techs and semis and energy suffering. The whole energy complex still part of the global slowdown because of Corona. I'm interpreting that as. Defensive plays once more. The power shares, clean energy, PBW, continues to be very interesting. Only U.S. tech standing out. Energy sector and materials very weak. U.S. leading the way. Asia very weak. Not much to choose from in there. All Russia all the time. That's keyed to energy, but it's interesting to see how that is finding a positive play while there's a global slowdown and energy is weak, and yet Russia holding up. Odd. Biotech, white and green. That was great, now just good. Preserve your profits, watch for resumption. So that's how I interpret IBB. Liquidity, shifting to the daily. Lots of channeling and overreactions to choose from, basically the weaker globals. If they continue to be weak, that's the first place you want to look to be short. Some of your key tech winners, Cisco, Microsoft, are in the 10-day max pains. Lots of auto framers to choose from on the weakness. Plenty of channeling and overreactions to look at. Some 5DD here in Boeing will be of great interest, along with the RSI 2 value of 1. So Boeing's on the short list. Gains here, silver, gold, and treasury, so that makes wheat and precious metals excellent. Defensive plays are leading the way. Gold, real estate, treasuries, utilities, silver. Let's see the big breakdowns. Merck, Pfizer, Latin America, and Brazil. Lots in the auto framer to choose from, including some key sector leaders, and with all of the mechanical framing data already prepared for you, and a reasonable level of risk to get started. Regression line fractals, top shelf. These are the deep value plays. Merck, ExxonMobil, Chevron, Disney, Verizon, and then the relative strength leaders, Intel, United Health, Johnson & Johnson. The daily squeezes, these had narrow ranges on Friday, and then if we just get a range stat move, then these become very interesting. Disney, Boeing, Chevron, Pfizer, lots to choose from. You can see the breakout of 4 seasons for the symbols of interest in the swing, core, and turbo portfolio. That's those candidates that I follow religiously. And then the 4 seasons of the ETF 30 and the Dow 30, ranked by where they are with respect to their own Red River. So springs are the ones that are starting to make gains as they approach the zero line, and U.S. Steel is the most advanced one of that in this stack, so that's why it's on my list. Multiple time frame NDX summaries, the breakdowns and where they are in their stack, in their index on the different look-back periods. Bright red were the ones that broke down below that previous look-back period, so these were collapses. And then solid bright greens are the ones that had breakouts to the upside out of the previous look-back period. So Coke should be on our radar for doing well in bad times. And meanwhile, gold, silver, treasuries, real estate are the big 4. So these are ranked by 10-day look-back, so that really supports starting your analysis with swing trade, middle-term time frame for swing trade context, and then look to refine for breakout. So Johnson & Johnson would then be of interest. Still has room to go to the 10-day high, but had a 3-day breakout, so that could be almost like a lazy man's triple screen. Price rolling over, 2 days of selling in a row, getting ready to test key support levels here, already below the regression line. Slope of the regression line's rolling over, rejecting that stretch. And then, as we said last week, those declining highs, it's a period of, you're almost getting this triangle. So a real important decision point here of what kind of market we're going to have. You know, you got to say, though, if the Democrats continue to melt down, what's the alternative to Trump, and what's the positive effect he's going to have on 4 more years? So we'll see. The 90 is definitely rolling over. Gas is coming out of the tank. The 30 is declining highs. The 10 went to a 2.5Z and rolled over, so it's the last 2 days are not surprising whatsoever. But now that brings it right back to a key support level, which used to be resistance level. The last time this was tested, it broke through. The last time it came back to the edge of the river, it collapsed. It held, it collapsed. So that makes this, fair game for sharp moves in either direction with rising volatility. And as the risk C is going into the winter session, short-term trading, high time to focus on that for your turbo trading. Be ready for those short, sharp shocks. We saw how to play that on the weekend podcast with multiple case studies in SDOW and DIA, just in the big broad indexes, and then the VIX was very nice for us for ETF intraday trading as well. So lots to look at, lots to frame. Keep your risk measured and your powder dry. We'll see you in the chat room and on Patreon. Thanks for your kind attention.